y'all. Welcome to another episode of Talks with the Tax Cop. This been an interesting uh week or so, just because of the weather. The the snow has had everybody, and I do mean everybody, in Casa de Berry around. So we've got to be tripping over each other and everything like that. I love my family. I do. You know what? When you got to tell yourself, I love my kids. I love my husband. I love my family. I really do. I definitely do. It has definitely kept me on do this, do this, do this. Make sure I keep the boundaries. Make sure that we get things done the way we need to do so I can separate um, business and personal to make sure that everybody gets to where they need to get to. Some days I'm great at it, y'all. I'm just having a talk with y'all. For those who don't know me, I know y'all probably like, what kind of introduction is this? For those who do not know me, my name is Patrice L. Berry, EA. That EA stands for Enrolled Agent. I am here on my podcast, Talks with the Tax Cop, where we talk about all things business and reality. The purpose of the podcast is for us to share tax tips in the area, from things you should be aware of. If there's tax problems, how do you maneuver in that space? But in reality, I created this so that I had an environment to talk to other entrepreneurs. I love interviewing people. I was an auditor for 20 something years, and a big portion of auditing is interviewing to understand the processes and procedures, get to meet the people that are doing the work, so that we aren't just making crazy recommendations that aren't able to be feasible, right? You want to talk to the people, and most of the time, the people that are doing the work know exactly what the fix should be. And so, my favorite part of auditing was interviewing, which truly was interviewing and learning processes and procedures. Yeah, I do like to follow the money trail. I'm not gonna lie to you, because I've done financial statement audits, I've done process and procedure audits, I've done peer reviews of reports to making sure that all the stuff was cross-referenced. But my favorite part of the audit, besides planning, was truly going out in the field and being able to see it, observe it firsthand, and interview the staff that actually does the day-to-day. I love to learn new things. I'm constantly learning. I am constantly putting myself in a space where I can gain more knowledge. And I love all things tax. So that may make me a big weirdo, but I truly do love all things tax. And so therefore, I am the tax cop on these social media streets, on these branding streets. That is my brand, the tax cop. And I am here to make sure that you know all the things that you can get around with and what you can't. So I tell people I tiptoe on the line. I'm not a habitual line crosser. Not a habitual line crosser. I am a tiptoer. I am a line tiptoer. And I will break dance on the line. I will moonwalk on the line, but I will not cross the line because I don't charge go to jail prices. We don't do that. That's absolutely crazy. Don't nobody want to go to jail. Don't nobody want to do anything. IRS got my fingerprints on file. I don't want to give them no reason to come bother me. And if they do come ask questions, I definitely am prepared to be able to answer those questions for me and my clients. So that's who I am. As I was saying, it's in January, right? So we are in January 2024, and we've had weather where I am. I live in Southern Maryland. And even though I have clients all over the country, and actually international, I do have U.S. clients that are international as well. We serve where we can serve. Isn't that the great thing about the internet? Y'all probably think this chick is rambling today, but isn't that the great thing about the internet? It truly is a great thing about the internet. If you have an internet connection and you can connect with people where they are, break things down, you have a mechanism to be able to serve them in a way that is feasible for them to understand, and they are willing to compensate you for that service, then you can do just so many great things. That's really part of the reason why I created this podcast, because I wanted to be able to have a space to interview my clients so that they could share their origin stories, because you just don't want to hear me talk about stuff all the time. Just for you to be able to hear origin stories and learn new topics. Now, this week's podcast, we're going to talk about wonderful. My youngest is around showing me his schoolwork. Um, this week's podcast, we're going to talk about life insurance. And we're going to talk about it from a couple of different things. Now, first and foremost, I'm going to caveat this really, really, really hard. I am not a fiduciary of any kind. The only thing that I can do is practice law. So anything I tell you is for educational and entertainment purposes only. And I am going to show you how this comes out in the tax code. I do not have an insurance license. I cannot sell products. I cannot sell services. Any scenarios I tell you is anything that I've applied to myself personally. This is not even scenarios for my clients. This is something that I have done personally, right? So I do definitely believe you need a life insurance policy. And what I am going to do is I am going to actually do an interview with my insurance agent, my life insurance agent, who has helped educate me. He knows I like to know the stuff and learn the rules and see where it comes from. I'm all about the sources. And I wanted to share an article with you all that he shared with me right at the beginning of the year or end of the year, right at the holiday time frame. And then I want to go, of course, to my handy dandy tool, Bradford Tax Institute, so we can talk about it a little bit. And then I am going to actually go to the code itself. All right. So we're going to do this episode a little bit differently. Normally, we go through all our segments and we talk about audit and awe and fraud funnies and all these things. But today, I wanted to do things a little bit different. Y'all gonna let me do it a little bit different? It's gonna really be a more educational sharing of stuff so that people, because I see on social media a lot the argument about should you have a term policy versus a whole life policy and who's doing it and it's a scam and all this kind of stuff. Life insurance is in the tax code. And so I want to show you it's in the tax code. Proceeds from life insurance policies are normally tax-free, right? So you get proceeds from a life insurance policy, you're not paying taxes on it. I just want you to see the tax implications associated with it so that you can go out and go have a conversation with your insurance person, or if you are hesitant to going to get insurance, I want to point you in a direction of getting you some resources so that you are prepared to leverage what life insurance can do and how life insurance can protect your family, really. And it's not that anything major or drastic has happened in my family. I can tell you that at a young age, when I came out of college, my parents had me and my brothers, when they finished college as well, go through and talk to a financial planner. And it gave me the catalyst to want to go out and learn really truly how all this money stuff works. And insurance is a part of that legacy building thing that we all talk about, but not necessarily get into it. Yes, they sell products, mutual funds and things of those nature, right? Life insurance, and then you have a money market account savings, right? High yield savings. So you'll have like a three tier stool. That's what they use in that arena. And like I said, anybody who out here listening, I am not a financial planner. Please don't come for my neck. Don't come for my pearls. Don't come for my neck. Just don't come for my cert. Don't do it. It really is. I just want to show how it works from the tax side of the house. That's it. Y'all do what y'all do. I'm not here to argue or tell you work with this person or not this person. I'm not here to tell you whole life versus term. I'm not here to do that. What I am here to do is explain to you that, number one, life insurance is in the code. It really is in the code. That people do use life insurance to leverage things and to help to build their wealth. And I'm going to show you in the code also how, if not done correctly, it can become catastrophic for you. So I really want you to talk to the right people, right? And when you're planning and you're doing it from a tax planning stance, I want you to be able to know what kind of policy you have. Is it a whole or a term life, right? Is it building cash surrender value or is it not? Really? And do you have any loans against any of these policies? And if you do, making sure you stay within those rules. So that's what we're going to talk about today. Really, we're going to look at it from my lane, not from anybody else's lane. So let me share with you the article that was shared with me from my person. Let me see if I can bring that up automatically. I'm gonna share my. No, do I want to share my screen? Share my screen is lot. It's not on this one. Let me go to a share screen view. All right, so I'm gonna actually take it to a different screen today. That joint is locked. I'm gonna bring. Let me. You know what? It's easier if I just bring the article over. Where's the article sitting up with? Y'all bear with me. Y'all see that? Can y'all see that? There we go. All right, let's do this article, and then we'll go from there. I will build from here. Let's make this a little bit bigger so y'all can see. All right, so the article that was shared with me was from October 3rd, 2022. It says why index universal life insurance might be the new 401k. And in this article, it talks about the difference between IUL policies and whole life policies, the return, essentially what your return on investment could be by using these different policies. And really what's going on in that arena. I'll actually share a link to this article that was given to me. Then they go into why a life insurance policy, an IUL policy, might be better than a traditional 401k. But this is the thing that breaks it down. Why? Right? Life insurance presents certain advantages over 401k. We're going to actually go into it momentarily. With life insurance, you can anticipate that you always have. You just gonna jump in on the podcast? They can't hear you. They can only see you. You goofy. All right. So it say with life insurance, you can anticipate that you'll always have money coming in, even when the market goes down. Your money is locked into the percentage rate determined when you bought it, and when the market goes back up again. You get all the gains. You never have to suffer a loss. The IUL model is more complex as the rate is determined by what's going on in the stock market at the time. But with its compound interest, this investment's cash value has the potential to make you more money tax-free through IRS tax code 7702. And so that's really what I really wanted to talk about today. IRS tax code 7702. This capability allows you access to a retirement tax-free income for the rest of your life. Plus leaves a death benefit for your children's 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 children. How many children? Say it 4 times fast, right? So this is where we really are talking about leveraging life insurance policies to build legacy, as well as we are figuring out what's going on with the tax code. This is a substantial amount of multi-generational wealth to leave your family. They can't see you.
I'm on a camera.
You're just in the shot. But you really should not be. You gonna say hi to the people because I'm recording a podcast. Hi. Say hi. They can't. It's not live.
Hi.
Hi. Hi. Tell them hi. I'm always interrupting.
I'm not gonna tell them. I'm always interrupting.
You're not gonna tell them. All right. Get your book, and when I finish, we are going to finish your schoolwork.
You know that those people heard that.
I definitely do know the people heard it because you are interrupting the podcast, and I gotta switch screens, and you on the way, and your mama not that great at always with her production. It's acting funny on me today. You got it?
Yes.
All right, get that, and I will come help you in a little while.
Okay.
All right.
Okay.
Thank you, dear. All right, so that is what triggered today's conversation. This is what triggered today's conversation. IRS tax code 7702, access to a retirement tax-free income. We're gonna dive into that momentarily. All right. So that's from that Safari page. All right. So back on the screen. Okay. So I showed you where that came from. We're gonna do a quick conversation about that section of the tax code, so y'all can see it for yourself. So y'all can see, she's not making this up. I pulled this from Webby Library, the tax book. I got a lot of different resources I use, y'all. All right. So from Webby Library, let me see. Do I need to zoom? That's tiny. We're gonna go in. Let's make it a little bit bigger. Hopefully we can get it on the screen. All right, cool. All right, so so y'all can see actually what I'm talking about for those who are actually watching it online. It's section 7702 life insurance contract defined. This is directly from the Internal Revenue Code. The source I used to pull it was the tax book because I like the tax book. It's easy for me to maneuver. Okay. So we have the definition of life insurance. For the purposes of this title, the term life insurance contract means any contract which is a life insurance contract under the applicable law, but only if such contract meets the cash value accumulation test of subsection B, which we'll go to, or meets the guideline premium requirement of subsection C and falls within each cash value corridor of subsection D. All right, so the IRS is telling you, hey, this is how we're handling stuff with cash surrender value. Okay, cash value accumulation test for subsection A1. A contract meets the cash value accumulation test of this subsection if, by the terms of the contract, the cash surrender value of such contract may not at any time exceed, let me take it over, the net single premium which would have to be paid at such time to fund future benefits under the contract. So as long as this cash surrender value does not exceed the value of the contract itself, the value of the policy itself, then that's what they're looking for, cash accumulation. The determinations under paragraph 1 shall be made on the basis of interest at the grade of the applicable accumulation test, minimum rate, or the rate or rates guaranteed on insurance of the contract, on the basis of the rules of subparagraph B1, and in the case of qualified additional benefits, subparagraph B2 of subsection C3, and by taking into account under subparagraphs A and D of subsection E1, only current and future death benefits and qualified additional benefits. Y'all, let me tell y'all something. This reminds me of reading criteria when I'm doing stuff for audit to make sure I understand stuff. Criteria is important. What rules are going to apply and what rules aren't going to apply. This is our background on it, right? So you got to know definitions. Essentially, a contract meets the guideline premium requirements of the subsection if the sum of the premiums paid under such contract does not at any time exceed the guideline premium limitation as of such time. Then we got our definition for guideline premium limitation. Cash value corridor for purposes. In general, a contract falls within the cash value corridor of this subsection if the death benefit under the contract at any time is not less than the applicable percentage of the cash surrender value. And it goes through the ages, the applicable percentage rates, tells you how to what to computate. The death benefit can't, for the purposes of the section, the death benefit shall be deemed not to increase. The death benefit shall be deemed to be provided until the maturity date determined by taking into account, essentially maturity date, meaning the person passes on, right? You got to pay premiums. In general, the terms premiums paid means the premiums paid under the contract last amounts to which Section 72E applies, unless any excess premiums with respect to which there is a distribution. Essentially, if you take a loan against it, right? You got a cash surrender value. You got cash values, right? We got a cash surrender value. The cash surrender value of any contract shall be its cash value determined with regard to any surrender charge, policy loan, or reasonable determination dividends. Net surrender value. The net surrender value of any contract shall be deemed with regard to surrender charges, but without regard to any policy loan. Meaning, I subtract any loans away from the policy amount on the day that you have to collect the policy, because the owner of the policy is now deceased, right? So what is that net? That net money that's left over minus any loans. So cash surrender value is the cash accumulation that is happening in the policy based on whatever the terms of the policy happen to be. If you decided that you wanted to go and take nothing but the cash surrender value out, there's ways for you to do it, right? So then we got death benefit. The death benefit means the amount payable by reason of death, right? That's essentially 9 times out of 10, that's the face value of the contract, right? Or the life insurance policy. Meaning you bought the policy for $100,000, or you bought the policy for $1 million on the date of death of the person who holds the policy, or who owns the policy, meaning that those that are listed as beneficiaries on the policy will receive that death benefit minus, in most cases, any loans and any other things that are going on with that policy. Okay. Future benefits. The term future benefits means death benefits and endowment benefits. Let me see. Rule for certain changes, adjustments in general, recapture ceiling. Recapture ceiling where change occurs after the 5th year between the 16 years. So all the different terms in the policy, the insurance interest rates, valuation interest rate, the federal interest rate, adjustment year transition rule, treatment of contracts which do not meet the subsection A test, cost of life insurance protection, treatment of amount paid on death of insured, endowment contracts, transitional rule for certain pay, certain church self-funded death benefit plans treated as life insurance. What? For people in the church, right? That's section 7702, all the statutory rules and everything like that. I mainly wanted to show you we got different cases and different definitions, etc. That life insurance, the definitions, the policies, how it should be determined, what the rules are, who can do what, when they can do it, actually is in the code. It's actually, life insurance is in the code. Surrender value is in the code. Death benefit is in the code. This is the code itself and what they're talking about. All the definitions, so you can know how it's wrapped into to be defined as a policy itself. So when people are like, well, how can we do this? And what can we do? And how are y'all using it as the bank? And how come y'all can't tax it? And what, like when we dive deeper into it, you would find what can be taxed, what can't be taxed, what's taxable income, because you have a whole publication that tells you what you can count and what you can't count. What's taxable, that's publication 17, tells you what is and what is. All of these, we got so many different things that tell us in the code what we can do and what we can't do. You just got to know what those items happen to be. All right. So, but I want you to be mindful. I really want you to be mindful. So, like I said, we're going to bring on someone who's in the insurance field because that is not my specialty. My specialty is making sure I got the documentation, making sure we are considering it in the plan, making sure that we are thinking about what this does for you and your family and how to leverage it if you actually have it. And then I outsource, like not even outsource. I make a referral out to people I know that are in this field so that you can go have those conversations and ask those questions. But I do think it's a part of when you tax planning that you want to make sure you have enough life insurance. Okay. And the reason why is because y'all know I like to take scenarios and cases from Bradford Tax Institute because they do a good job of doing it in plain English, breaking it down, and we can talk about the things we need to be considerate of. So this is an article from April 2019, not too far ago, but not too close. How taking loans from the life insurance policy, what you need to be aware of in reality. Keep in mind, normally the policies that build cash surrender value are whole life policies. That's all I'm gonna say. You go talk to your financial planner or whoever is actually providing life insurance that you can buy. Ask them the necessary questions. But in most cases that I've been aware of, cash surrender value is happening in whole life policies, right? Not necessarily in a term policy, but in a whole life policy of some sort. IUL was one of those type of policies, right? So let's go into this case, and then we'll go from there. All right, I'm gonna share the screen. All right, life insurance policy loan, a tax nightmare. Bruce Brown fell into the life insurance policy loan trap. Why else would you have a policy if you can't in this building cash surrender value and you don't take nothing to get? Like what? Come on, don't talk about the man like that. Let's see why he said trap. Mr. Brown, a commercial litigation attorney, purchased a life insurance policy from Northwestern Mutual Life Insurance Company. For the first 6.5 years, he paid the insurance premiums by check. For the next 15.5 years, he paid the premiums by borrowing at 8% interest against the policy's cash value. Because of the borrowing, the year 22 annual interest accrual was twice the insurance premium due. This was a problem. All right? So we got a bigger problem. But a bigger problem was that Northwestern could terminate the policy if the policy debt exceeded the cash surrender value. We saw that in the code, right? You got to make sure it don't exceed the rate, the actual face value of the policy, right? So they could terminate the policy if the debt exceeded the cash surrender value. To mitigate this problem, Mr. Brown surrendered his $31,063.30 of an additional paid-up insurance that he had earned over the 21 previous years by investing his Northwestern policy dividends to buy additional paid-up insurance. So he took his earnings and essentially reinvested it or gave it to the policy. Unfortunately, his surrender of the additional paid-up insurance did not cure his problem. The surrender simply reduced both the policy debt and the cash value of the policy. Thus, after the surrender, Mr. Brown continued to have policy debt in excess of the cash surrender value. So what he thought he was doing, it did not do. At the end of the year 24, Northwestern terminated the policy because the policy debt, the loan he had taken out, exceeded the cash surrender value, and Mr. Brown's tax nightmare began. So first and foremost, before we talk about anything else, you need to know what's my cash surrender value, how much loans am I taking out, how am I repaying it? Like this is some of the stuff they don't tell you. This is some of the stuff that they don't tell you. You can take a loan and do all this kind of stuff, and right? Well, let me not say they don't tell you. Make sure you have an insurance person who forewarns you of this stuff, because you want to make sure that your whole purpose of being a bank, right? You paying yourself back. You're not trying to have a taxable transaction, but we have generated and triggered on the tax switch, right? So let's talk about why that's the case. Northwestern sent Mr. Brown a form 1099-R. Now the 1099s, I've told y'all, is the snitch forms. Essentially, they are miscellaneous forms That's where whoever gave you some money tell you what kind of money they gave you, and the IRS know, hey, you need to tell us about this money, whether it's taxable, it ends up being taxable or not. We know you got it. Don't not report it. Put that joint out there because we already know, and if you don't tell us, we're gonna put it on underreported. You don't want no underreporting issue for no reason. All right. So they sent him a 1099-R that described $37,365.06 as loans repaid at surrender and reported. So they gave, this is the loans, and reported $29,093.30 as the taxable amount at surrender. What? He doing all this stuff. I don't even got the money. Mr. Brown and his wife, Miss Carolyn Affinson, who has her Master of Law degree in taxation, believe they received the 1099-R in error, and they did not report that $29,000 as taxable income. Not reporting 1099 income, as I told you, is a mistake. Why? Because they already know it. And even if it's not taxable, you should report it. Okay? Just write, there's a way for us to make it say, hey, it's reportable, but it ain't taxable. Right? So even if you thought it wasn't taxable, you should have still told on yourself because they knew it. It drives the IRS computers nuts because they cannot match the 1099-R to the tax return. Now, I told y'all before in a previous podcast, almost everybody gets audited. Why? Because the computers are doing a match. Do the names match? Do the social security numbers match? Do you have all the documentation that we know that you're supposed to have? That is a type of audit. It's a check and balance. Okay? The IRS assessed the tax that would have been due had the $29,093.30 been included in the tax return. Hey, they said, hey, you owe us some money because you didn't tell us. We're going to assess tax on it. The Browns disputed the tax and took the case to court where they lost and also were tagged with a 20% penalty for substantial understatement of taxes, an underreporting penalty. Of all the penalties I don't like, let me tell y'all, of all the penalties I don't like, I can't stand an underreporting penalty. Y'all saw 20%. On top of all the other stuff you're gonna give me for not paying and all this other stuff, I feel fluxed. I do not like an underreporting penalty. I do not like an underreporting penalty. So I'm gonna tell y'all this trick. I've said it before. For some of my clients that be in certain situations, let's say you do a whole bunch, you might have a retirement, you do a lot of stuff with trading stocks or gambling. Sometimes I may tell you, hey, let's do an extension until we get till May, June timeframe, when I can go pull your wage and income transcript and I can understand and figure out what the IRS already reported on you. Because I want to make sure that all the documents you gave me are the documents that somebody told on you for. Why? Because I don't want you to have an underreporting penalty. Because it's 20%. On top of any stuff that we would have excluded unbeknownst to us. Right? Because sometimes like emails are coming through now. I'm flagging my emails for my tax process, right? For my personal tax process. And I'm like, okay, now I'm going to be downloading over the weekend and uploading it to my own personal organizer so that I don't have these issues and making sure, okay, I got a brokerage account here. I got this here. I got this statement here. I got a mortgage statement here. I got this interest statement here. I got a 1099-R that came in the mail. All these things. I'm going to start uploading them into my secure portal so that I can make the moves that I need to make sure I got all my documents. And then I'm going to go through my list and I'm going to compare to the previous year and say, okay, did we do anything different? Did I add anything new? Do I have all the information that I'm supposed to? And even if my tax return is done, and I might not be like, I may wait. I might do an extension. If I got to do an extension and look like I'm going to go and send them people some money. Right? And I'm going to wait to make sure everything is captured because I have been in a situation before personally where I've gotten an underreporting penalty. It is not cute to get an underreporting penalty. I have dealt with my clients where we've had to go through stuff. Now, is there ways that you can get out of an underreporting penalty if the IRS happens to be incorrect? Yeah, but if they not, And there's been some cases where they have not been incorrect. They have been 100% on point, and we've been 100% wrong. I would rather you not have that penalty. Okay, that's my little soapbox. Y'all know I normally got what kind of soapbox of some sort. All right, so let's talk about what happened, the full story. Many taxpayers borrow against their insurance cash surrender value. There's nothing wrong with that. In fact, a common wealth building strategy, y'all. Let me make this a little bit bigger so y'all be like, Patrice tripping. No, she not. Y'all can see this for yourself. A common strategy, right, is to borrow cash value during your lifetime and then have the insurance company offset the death benefit by the outstanding loan amount when you die. That's that net we saw in the IRS definition. That's that net benefit, net cash benefit, right? So what we're going to do is we're going to reduce any fees, any things like that, any loans, and we're going to pay out to our loved one anything, right, that we have not paid back based off of the face value of that policy. That's what it's saying. That's a strategy. That's when they talking about, hey, use your life insurance policy, you become the bank. But you need to watch this, right? But when the life insurance policy terminates before death, the cash surrender value is taxable. And the Grim Reaper is looking for their tax dollars. I ain't say that. That's what Mr. Bradford Tax Institute said, right? So if the life insurance policy terminates before death, for whatever reason, you don't pay the premium or they terminate it on your behalf because you didn't follow their rules. That money you took out now ain't a cash free. It's not tax free. That's income to you. And the tax man want his money at the federal and the state level, y'all. At the federal and the state level. In this case, Northwestern did not send any cash to the Browns because the entire cash surrender value was needed to pay off the loans. In the days of tax shelters, the receipt of taxable income without the receipt of cash was called phantom income. Y'all probably like, she doing extra. I need to work on my StreamYard. Phantom income, right? As noted by the court, here's how the Northwestern policy worked in their case. All right, so we see surrender value at termination used to pay the loans, $37,365.06. Surrender value from paid up insurance policy used to pay the loan, $31,063. Dividend payment, $2,986 dividend payment, an additional dividend payment. Say Mr. Brown, but I'm thinking maybe it's to Mrs. Brown, Mrs. Brown, $1,883. So the total monies earned and paid out by Mr. Brown, this is his policy, was $73,298. Monies invested in the policy premiums paid by the loan, $28,532. Policy premiums he paid by check, because remember he said for the first 6.5 years he paid $11,999. Policy premiums paid by applying dividends to these premiums, $3,674. Total investment in the policy, $49,000. Then it becomes what we talk about, y'all, basic math. I told y'all, in most cases, taxes are addition, subtraction, multiplication, and division. I'm going to say it again. Addition, subtraction, multiplication, and division. We not doing no trigonometry. We ain't doing no calculus. We ain't even doing algebra. We just doing basic math. So they took the money that he earned, right, versus subtracted from the money that he invested, that difference. Boo, they don't match. You owe us some money. That's the taxable portion. That's how they came up with that taxable portion. They don't match. Don't match. You received more money than you put in. Bruh. So that extra money that you got, and it didn't even get in your hands. Remember they told him he didn't even get it because he did the loan thing. $29,000 taxes. Note that most of the action on a life insurance policy took place inside of the policy itself. Mr. Brown ain't even get to touch that cash. All right, so here's our takeaways. Always got to be a takeaway. Look at the cash value in your insurance policy, including those that cover your children. Are you using cash values to pay the premiums? This is a great discussion. And definitely when I bring Rod on, that's my insurance guy, I want to go into this. Hey Rod, can you break this down? How does a person know when they are when they're doing a repayment? Um, how much of that is not my cash value? How do I know that it's me? You know what I'm saying? Because how do I know? How can I go in and look at the policy myself or look at the statement on a monthly basis to see what that split is? So those are some questions that we'll ask. And I want to ask somebody who's in that field, y'all don't, so we can know. If so, are you creating a tax liability upon termination of the policy? If yes, is it possible that the insurance company will terminate your policy and trigger taxable income to you? You got to know what the terms of the policy are. If so, start your tax planning now to offset the taxable income or put aside the money you need to pay the taxes. So that is one thing that I wanted to share with you all so that I can bring it forward when we end up talking to Rod. Hopefully I can get him on a podcast in the next couple of weeks. I don't want to spread this out too far. Next week is a podcast with myself and my husband, last week of the month. But I wanted to do this different. Like I said, not fraud funnies, not audit and awe. I mean, this could have fell in some of those categories, right? We will be picking up cases and be like, hey, don't do this, y'all. But I thought this was interesting because I'm just now hitting meetings with my clients that are doing tax planning with me for the year. And one of the questions I do ask about is retirement, and we also ask about life insurance, right? So that I can point them in the right direction, and I want to make sure people have it covered. Life insurance is a great tool. It will get, if you have enough coverage, it will allow your family to have peace of mind when you're no longer here. So if you got property and stuff like that, yes, it'll allow you to be buried. It'll allow those assets to be taken care of. It's supposed to help, how do we take care of your income, replace your income, right? Especially if you're one of the primary earners in the household. How they can leverage it and how they can reinvest it in the estates and build on it. It's just so many questions and more that I want to have a discussion with someone who's in this arena, and where I can interview him and ask him those questions. If anybody is listening to this one, if there's questions that you have in this space and you really wanted to know, send those questions to me so that I make sure that I get the questions that you want answered. Because life insurance is something that we definitely, especially in the Black community, in the American Black community, we need to talk about, right? And then for those who are listening that aren't Black Americans, if you don't have a policy, you need to make sure that you I can only speak from my experience in life, right? So that's what I'm telling you. I hear people and I don't have this and I don't have it. Why? And it's not an argument, and I've had people argue with me, term versus term versus whole, this, that, and the other. I just wanted to let you know, life insurance actually is in the tax code. Life insurance, the proceeds from life insurance aren't taxable, right? But we do have situations where stuff that happens with a life insurance policy can be taxable. That's why I wanted to show you this to you. Like, we're trying to build wealth and we're trying to, get to the bag and want to be the bank and all these little tips and tricks that are out there and quick clips that are shown on Instagram and on Facebook and on YouTube. But I really want us to be aware that, hey, stuff happens. And if we aren't planning all the way through and realizing everything that can happen and understand the rules that are embedded in our policies, what can we do and what we can't do with our policy, whether it be term or whole life. I want to know what I can do with my stuff. It's a young lady. She doesn't even know who I am. Lindsay Smith, the agent. She has a book on Amazon. She does a great job. I tell my clients when we're doing consults, follow her. She does a great job to me of breaking down life insurance in a tangible way. In a tangible, piecemeal way. I've listened to a couple of keynote speeches that she's done, and I like the way she resonates for me. She might not resonate for everybody, but she has decent content on Instagram. She breaks things down. She has a book on Amazon. and breaks it down in palatable pieces. And of course, I like working with I have two different guys that I work with for life insurance. Um, and my guy Rod is the one who sent me that article. So I definitely want to bring him on and have a conversation. He's chill, he's laid back, he ain't as amp as me, and he'll answer the questions. And then he gives me resources. He gives me resources. Not that my other guy doesn't, but he does definitely gives me resources, and he's giving me a lot of material, and I can run a scenario. He'll be like, okay, Patrice, let me break this down for you. And so I definitely enjoy speaking with him from that angle. And if he doesn't know, he gonna give me the information. Like he'll tell, okay, I want to do this, I want to leverage this. And he'll be like, all right, let me run scenarios for you. Let me break this down. Patrice, okay, can we get in? I'll be like, can I read it ahead before we meet? Yes. Here's the stuff. And then when we get in, we just add it. We just add. And anytime I have questions afterwards, he's always available to answer those questions for me. So I'm going to check his schedule. I'm going to bring him on. I'll let him talk about his thing, but I will have some questions together. This is going to be this one situation we talked about with the Browns. I'm going to come back to it and ask him some questions and ask him where we should look on our policies. How will we know? Where should we know? How do we look at our statements? How do we find our cash surrender value? Stuff that these some of the questions I ask him all the time. For okay, how much do I got? Okay, when can I take a loan? Okay, what am I going to do? Depending on what I'm doing with what policy. And I would love for anybody who's listening to my podcast, who's watching us on YouTube, who's looking at clips on Instagram, to actually hear from him so that we can actually break this thing down, demystify it, point you in a direction for someone who will at least answer some questions for you in a way that you can absorb it. A couple of these resources, like I said, I'll have Lindsay's book, and I should have had it, right? So I can show it to you. But yeah, I want you to tap in, just like we're here to demystify this space of accounting and tax. Life insurance should not be something that we don't know anything about. Yeah, y'all saw all the code language is confusing, right? But it really should be a space where you can come in and you can learn what it is that you need to learn. And at least feel like you got a safe space to go to get those questions answered. So, I mean, this was a long running diatribe of me just talking about a topic that we probably don't dive in too deep enough. I'm going to find some other scenarios that we can discuss too in a plain language way. But I want to show you real quick. Again, this is why I love the Bradford Tax Institute. Here's a tax memo from 2011. That's what it was based on, and they just summarized it. So if you wanted to go look at the case yourself, it's here. Bruce A. and Carol Affinson Brown. Let me make it a little bit bigger for y'all so y'all can see. Filed April 12, 2011. Bruce A. and Carol Affinson Brown, petitioners versus Commissioner of Internal Revenue, responded. They took it to tax court, and it breaks down all their business and takes it down. We are actually, when we go into fraud funnies and audit and all and things of that nature, we'll go to the cases. So now you can see all the details in the cases, 25 pages. If you ever were interested in knowing exactly what happened, what he paid, how he paid, all the details are in these cases. This is interesting stuff to me, y'all. This joint make me giddy. Be like, ooh, what? Huh? What? But that's why I love the Bradford Tax Institute, because it summarizes it in plain language and then gives us tax nerds where we can go and read it for ourselves, right? And break that thing down. So that's what I have for you all. If nothing more, I hope I piqued your interest. I probably confused the heck out of you at the beginning when I was showing you Section 7702. Y'all keep that in mind. Section 7702, where it starts talking about in the tax code about life insurance. But I'm not here to stress you out. I'm not here to make you a tax practitioner. I truly am here to have a conversation about stuff that we probably don't have enough conversations about, and show you how you can leverage this, and then bring those type of people in those spaces in, so that we can break this thing down, so you can at least get your questions together, or at least have information, so that when you go talk to your person that works in this space, that you feel like, you know what, I at least got me a starting point to go have a conversation, because now I know terms. I know that this is in the tax code. I know that there's ways for me to leverage it. I know that life insurance proceeds from a policy are not taxable, but if I don't watch it, that I could actually trigger uh taxable income when that was not what the intent was, while I was just trying to play this wealth game. But life insurance is a part of my tax planning strategy. It's part of my legacy building. It is a part of me getting to that next tier and leaving the things behind that I want to, while protecting my family. If that is you, um, please, please, please tell me, hey, that's me. Put it in the comments. Hey, that's me. Or tell me what you like. Tell me what you dislike about this. Tell me what you're afraid to dig into, because this is a topic that we should not shy away from. Not just because of the fact that it could be beneficial to us from a tax stance, but because um, life insurance is something that could actually help our families. It could, we could use it to help with our asset, protect our assets. It's part of our estate planning that we should not forget about. And then we should find out exactly how much we should have, and how to go from there. So, like I said, I'm only in my space from a tax stance. I only attacked it from a tax stance. I am not licensed to sell insurance, nor am I trying to. Okay, but I am trying to introduce you to people who are in that space, and have resources in that space, so that you can at least start informing yourself, so you know how to make moves, and do what is best for you and your family. All right. Until next week, if there's any topics that y'all are like, hey, she broke this down, I wonder if this is in the tax code, holla at your girl. Please holla at your girl. And then we'll be back in a couple of weeks to just our regular schedule. Hey, this is the topic. This is what's in here. Let's break it down. Let's go through our audit and all. Let's go through our fraud squad funnies. Let's see if we got a balance to beat, and do our other segments of the show. But until then, talk to you later. Have a great week, everybody.